Good morning, doctor. My name is Ong Jin Ho, and my metric number is 304137. Today, I'm gonna present about non-trust corporation performance and its determinants. First of all, I'm gonna talk about the background and problem statement. For the background, the non-trust corporation is one of the leading U.S. financial institution providing wealth management, asset servicing, asset management, and banking services. It is also known for strong financial position and conservative risk profile. And whereas for the problem statement, it has four problem statement, which is exposure to borrower default risk, deterioration in CNI loan quality, weakness in CRA loan performance, and profitability affected by rising credit risk. Next off, I'm going to talk about the research objective and the research questions. For the research objective, there's three, which is to analyze the impact of internal factors on the credit risk of banks in the United States. The second one, which is to analyze the impact of external factors on the credit risk of banks in the United States. And the last one, which is to analyze the impact of both factors. So moving on, which is the research questions. The first one, which is whether internal factors have a significant impact on the credit risk of banks in the United States. The second one, which is whether external factors have a significant impact on the credit risk of banks in the United States. And the last one, which is both of factors whether have a significant impact on the credit risk of banks in the United States. Moving on, I'm going to talk about the literature review. So I've put in four categories, which include the internal and external factors. The first one, which is the most important one, credit risk. So according to Chijoriga, credit risk is among the most important risks affecting the profitability and sustainability of financial institutions, as poor credit risk management may lead to insolvency. Moving on, which is the capital adequacy. According to Shrivers and Dahl, banks with higher risk weight asset ratios are generally exposed to greater credit risk due to riskier lending activities, while capitalized banks are better able to absorb losses arising from non-performing loans and maintain financial stability. The third one, which is loan loss provision. So Ahmed, Takeda, and Thomas found a positive relationship between LPs and non-performing loans, suggesting that banks increase provisions when credit risk increase. And the last one, which is GDP growth, Q reported a negative relationship between economic growth and default probability, indicating that stronger economic conditions are associated with lower credit risk. For the methodology chapter, we have dependent variable and independent variables. For our dependent variable, our study we use queries as the dependent variable, and for internal factors, external factors, and both of the factors together will be our independent variable. So external data will be used for financial ratios such as RA, RE, liquid, and many more. And we will use SPSS as our tool to generate descriptive statistics, correlation, and other analysis through linear regression. For the descriptive statistics, credit risk recorded a mean of 0.0033 with a relatively low standard deviation of 0.0014, indicating that credit risk remained fairly stable throughout the study period, which is 10 years. Among the explanatory variables, DR, which is 12.32, EM with 13.77, and loan size with 11.88, reported the highest average values, while LP, which is negative 0.0001, was the only variable with a negative mean. Overall, the standard deviations are generally small and relative to their means, suggesting that limited variation in the data and indicating that the observations are relatively consistent across the study period. Moving on, which is the correlation section, it turns out there is seven positive values including CR with the other variables and 14 negative correlations. And the variables stand out, which is uh, the most strongest and positive correlate, which is yield curve with an R value of 0.793 and P value of 0.003. And whereas for the strongest and negatively correlated variable, which is interest rate, which has a value of negative 0.862 and a p-value of less than 0.001. For the model summary, it evaluates how well each regression model and explains variations in credit risk. For Model 1, it demonstrates the strongest performance with an R square of 0.956, indicating that 95.6% of the variation in credit risk is explained by the bank specific variables. It also has the highest adjusted R square, which is 0.869, and the lowest standard error of estimate, suggests that the best overall model fit. For Model 2, it explains 87.9% with an adjusted R of 0.782 and a slightly higher standard error, indicating a comparatively weaker fit than Model 1. Model 3 also records a high explanatory power, but its adjusted R square is lower than Model 1 due to the inclusion of more predictors. Overall, Model 1 provides the best fit as explains the greatest proportion of variation and maintaining the highest adjusted explanatory power and the smallest prediction error. The ANOVA test determines whether each regression model is statistically significant. Model 1 is significant, which has an F value of 10.948 and a P value of 0.038, indicating that the bank specific variables jointly have a significant effect on credit risk. For Model 2, is also statistically significant with an F value of 9.056 and a P value of 0.016, showing that the macroeconomic variables collectively influence credit risk. In contrast, Model 3 is not significant with an F value of 6.222, P value of 0.145, and therefore Model 1 and 2 are considered valid regression models, while Model 3 does not provide sufficient evidence that the combined predictors significantly explain credit risk. In the coefficient analysis in Model 1, loan size is the only significant variable, which p-value has 0.009 and has a negative effect on credit risk. Other variables are not significant, and for Model 2, interest rate is the only significant variable, which value has 0.007 and shows negative relationship with credit risk. Whereas for Model 3 in contrast, no variables are statistically significant, as all p-values are more than 0.05. Overall, bank size and interest rates are the only significant determinants of credit risk, while the combined model does not produce any significant predictors. In conclusion, interest rate has been found to be most associated with credit risk, showing the strongest correlation and a negative nature. It confirms the great vulnerability of bank credit risk to any changes in the monetary policy when discussing effect of changes in the interest rates on bank risk taking. Whereas for recommendation, I recommend to strengthen foreign exchange risk monitoring, improve hedging strategies, and regularly assess the effect of currency movement, and also maintaining strong liquidity management practices to ensure financial stability during periods of market volatility. So there is all for me. Thank you.